All right, welcome everybody. Today is Tuesday the 5th, and this is our first live broadcast here down on the floor of the SIBO. Used to be the CBOE, now it's the SIBO, and I am standing live in the S&P 500 options pit. I actually used to trade in here a lifetime ago, but I am here and I am so happy to be bringing you the Minds of Markets live daily update. So every day, noon, we're going to be here and we're going to give you a market update. We're going to let you know what's going on with the markets, what's trading, what's busy, what are the top stories of the day, eco data. So all that good stuff. You'll have an opportunity to chat in, ask some questions here. But this is really cool, guys. What you see right here, for those of you that don't know that there is still live trade, right? Because most people think that trading is just done electronically, and for the most part, it is. But here in Chicago, on the SIBO floor, we have live trading here in the S&P 500 options right across myself at about 2 o'clock right over here. We'll get a camera on it later, is the VIX options pit. And then right next to the VIX pit is the Russell. So Russell options pit. Where those trade as well. But this is this is the cornerstone of the SIBO right here, the S&P 500 options pit. So right now, as I turn around, and you may hear some background noise, it's not that busy right now. The market's been pretty quiet today. S&Ps right now are down 14 and a half points. It's been really quiet. But if you hear an uptick in noise, everybody, that is because yes, there is live trade here. There are brokers, there are market makers, or what's known as locals, and they are trading. For the longest time, actually, since even prior to COVID, rules have been relaxed in the pit here where traders, brokers, anybody in here doesn't have to wear a trading coat like what we used to have to wear every single day. That is now going back into effect. I think they're trying to bring back some of the old time customs. So you may see some guys here wearing coats, but as of next week, I believe everybody will. So I will be donning my Prosper Trading jacket as well. So let me give you a quick market update. Then we're going to go into some of the highlights and some of the headlines of the day. So right now, S&P's down 15 points at 5282. Volume on S&P futures just over a million contracts. Average daily volumes about a million and a half. Right now, this is an uptick from where we've been over the last couple weeks, so we'll see how that plays out. I'm watching the board. When I keep looking up here to my left here, guys, I'm actually watching the live board. It's like the old ticker tape, if you will. Now it's an electronic board. We'll hopefully get a pan over there so everybody can see what that looks like. And what that tells me is not what's going on just in S&P futures, but also every option trade that is trading back here. So I can see right now the June, let's see, June, July, actually the June 20th, June 21st, 1 day call spread, 4,800 call spread, just traded 1,500 times. I am looking at the June 5th, so today, June 21st, 5,000 call spread just traded 1,500 times. Today's the 4th, Mike? Oh, today's the 4th. Tomorrow's the 5th. Whoops, so that's tomorrow's expiration. Oh, man, I am off it. I am so excited. I am off a day here, but that's okay. So let's talk about a couple things big in the headlines, and then I'm going to pull up some charts here that we can look at. First off, everybody's looking ahead to this Friday. This Friday is the May jobs number. Why is that so important? Well, this is the Fed's next big data point where they're going to, have some consideration about what to do with rates. We got through last Friday's PCE report. That's personal consumption expenditure index. That is what the Fed looks at to measure inflation. Now it's all about jobs. Ahead of that, though, this morning we got a number called JOLTS, JOLTS. What that stands for is the amount of job openings that there are compared to people looking for jobs. Now, that has been over the last couple years or so in this very, very tight labor market, there's been about 10 million job openings. That's been trending down a little bit right now. This morning's report, and this would be for the end of April, actually came in lower than expected. So it's about just over 8 million job openings. What that means is the labor market is starting to ease up a little bit. This is what the Fed wanted to see. The tight labor market, that was a problem for inflation. Now things are easing up a little bit. Can we look at just one data point and say, okay, this is what the Fed needs to see happen, so, they're going to make a decision to lower rates? No, but things are moving in the right direction. But got to be careful what we wish for, right? Because if we start to see the economy slow down, which there was some news yesterday also that some manufacturing data that came out that showed the economy is really slowing down, and if the jobs market really starts to slow down, again, that's what the Fed wanted, to be able to reduce rates. However, that could be a precursor to the economy slowing down and maybe leading us into recession. So it's a really fine balance there. And what we're seeing with these data points here are interest rates actually coming down. So, how do I know that? For those of you that don't know, when we look at bonds, whether it's the 2 year, the 5 year, the 10 year, the 30 year, the price of bonds is inverted to interest rates, meaning as bond prices go up, rates come down and vice versa. The 10 year, which is really the most closely watched of all of them out there, the 10-year yield, because that's what mortgages are based off of and your auto loans and all of that, that spiked last week and it spiked up to well over 4.6%. But just in the last couple days, that's off about 30 basis points or so down to 4.3%. 4% is kind of the number that the Fed is looking for to crack that and get back into the three handle to maybe give them a little bit more comfort that, okay, you know what, maybe we can start to think about lowering rates, which at this point right now, according to the CME FedWatch tool, which monitors probabilities of when the Fed may change interest rates, there's a Fed meeting next week. 99% chance they're not changing rates. There's another Fed meeting in July. It's about a 85% chance that they're not changing rates. But the September meeting right now, there's about a 60% chance that they are going to lower rates by a quarter to a half a percent. So a lot of that's going to depend on the eco data. We'll see what happens here. Things are a little volumes picking up a little bit here. When I say volume, not necessarily the trading volume, but the decibel level here. So things might be getting a little bit busier here. What else was in the news today? Again, we talked about the jobs market. We talked about that big number coming out on Friday, the May jobs report. So jobs added since the pandemic have been really, really strong, about an average of 350,000 a month. That has been coming down little by little. The expectation is for 190 to 195 on Friday. So that could be a big market mover. If it's a strong number meaning 250, 300,000, that's going to be bad for the marketplace. We may see a pretty decent sell-off. If the number is also really, really weak, okay, that may not be good for the markets because that could be more of an indication that things are really slowing down and we might be headed to recession. So that 190 to 195 number is really what they're looking for. And just as a quick summary here of what the Fed looks for with the job market, excuse me, a slowing of job growth, which is what they want. That is, they want to see that to get back to normal levels. The Fed has been in a battle, as we all know, and we're all paying, ridiculous prices for everything. The Fed has been in a battle with inflation, and they need to see demand soften. They need to see price hikes slowing down to get back to the position of potentially lowering rates. So that is going to be on Friday. We'll see what happens there. Again, good news versus bad news in the market. The softer economic data that's been coming out could be good news in terms of, okay, maybe the Fed's going to lower rates. Not so good news because slowdown, potential recession. So it's really a tug of war right now. Unbelievably though, with all of the um, uncertainty, let's call it, the market is really hanging in there. The market's still trading near all-time highs. Yes, the Dow, you know, tipped 40,000 a week and a half ago, and we're slightly below that now. S&Ps are just off, and I want to show you something actually with S&Ps here. Let's go over to some charts here, and hopefully you can all see these charts. If we look at this data point right there, okay, this is the SPX, this is the S&P 500. This is what I'm pointing to last Friday. Last Friday, on the sell-off that we saw last Friday before that ridiculous end of day rally, S&Ps came all the way down to 5191. Okay? The 50-day moving average, that red line you see there, is right around 5180, 5182 or so. So it held as support. That's a real positive for the marketplace. But if I bring in another chart here, what I'm going to do is I'm going to bring in the 20-day moving average also. So that's a little bit, you guys hear that back there? See, let's see what traded. I'll see it up on the screen here in a second. But if I bring in this 20-day moving average here, you're going to see it on this green. That's a shorter time frame. We're right there right now. The S&Ps are basically, let's see, we're at 52, traded down to 52.57. We're at 52.83 right now. That 20-day moving average 52.62. So that could be a line in the sand there also. Hey, Mike, getting a question from Robert here. I don't know if you see it there. Why is there only a dislike button? Do we have? Okay, Robert, I think it's there. Can everybody let us know? I'm looking at our chat here, guys, and you can live chat me and ask some questions. Robert asked about why is there only a dislike button, not a like button. I hope the like button is there. If you guys can all let me know in the chat if it's there, that would be fantastic because we want to get those thumbs up here. We also want to talk about on a daily basis here what you want to hear, whether it's market update, what's trading here, positions we might have. Kim, mine only has a number. Okay, I'm not sure what that means. I am definitely not a tech person. Um, so we will have to look into that. Oh, the likes are coming in right now. Okay. All right, Kim, Robert, I don't know where that's at, but the likes are coming in right now. So that's the S&Ps, guys, and we'll keep watching this here. S&Ps rallied a little bit here, down 13 now. So very, very calm, muted day. I want to show everybody something in Dell. So talking about the moving averages here that we just looked at, that we use often for support, for resistance as really good indicators. Let's take a look at Dell here, guys. I'm going to blow this up on the screen here. Okay, here's a chart, 3-month chart in Dell. Okay, this red line here, that's the 50-day moving average. Okay, look where it traded down to on Thursday and Friday, right down to that 50-day moving average. This was after their earnings. They had earnings last week, which actually it wasn't so horrendous, but the stock sold off probably because it wasn't as good as the street had thought it was going to be. But we look at that right here. Look at that 50-day moving average. The stock came down right to it, like almost to the penny. So again, moving averages, and their moving averages are just one type of indicator, but we can look at that as a point of support, point of resistance. If we go back on a 6-month chart here in Dell, we can actually see right here. Look at that. It hit the 50 and bounced. So what did we do here? We took a position. We took a long position actually yesterday in Dell, right when it was down at that 50-day moving average. Why did we take a long position? What does that mean? Well, we were looking for the stock to bounce off of there. We were looking for that indicator. So we got in a position. I'm not even going to say what the position was because that's kind of irrelevant. We paid $1.30 for an upside call position. We exited half of that today. Dell was up about $5 at its high today. It's off that right now. We exited half of that at 210. So we took 80 cents out of 130. That's 60 some odd percent on half our position in literally one trading day. Could we have exited the entire thing? Sure. But you know what? If this 50-day there is really going to hold, then we want to ride this a little bit higher. So there's always never a problem. There's never an issue. You guys got to remember this. There's never, ever a problem taking some profits off the table. And that is what we did there. Lock some of that in, and we'll watch and see how the rest of that plays out. One thing I want to talk about now that we're finished with May, we're into June. June's been a little bit of a tough start. Okay. There's that old adage that everybody, has heard, and I actually wrote about it in our week ahead last month about sell in May and go away. Okay. What is sell in May and go away? Well, typically people believe, and I'll go into some stats here, that the summer months are the worst months, worst performance months for the overall marketplace. And you know what? Even though the market typically does still go up in the summer, it's not as good as the rest of the year. So sell in May and go away is a theme. And if you were to buy at the end of October or November, hold till April, that is typically the best returns of the year. But this year, let me give you some stats here. Since 1990, the S&P 500 gained an average of around 2% May through October. Okay, so that's that, lack of performance, if you will. And that compares with a 7% gain from November to April. This year, not the same though. Okay, we saw massive rallies across the big indices. Yes, the Dow pulled back a little bit from that high there, but we saw massive rallies. So anybody that just kind of blindly followed that old adage of sell in May and go away, at least for now, not that it can't change, but at least for now, I'm going to go into that in a second, guys. I don't know if you can see behind me here the hand signals. I'm going to talk about those hand signals in a second. The sell in May go away has not worked yet. Now, one other kind of stat maybe you want to know. This is an election year. Who didn't know this was an election year, right? And no, we're not getting into politics right here. Election years tend to be bullish. They're even more bullish when a sitting president is running for re-election. Okay, the S&P is up almost 13% on average during years when the sitting president is running for re-election versus just an open field. When there's nobody in office running, which when that happens, the S&Ps are actually negative 1.5%. Now, why is that? Why do you think that is, everyone? And those of you who are in, one of our classes, you may know the answer to that. What doesn't the market like? The market doesn't like uncertainty, right? Whether it's the uncertainty of the war going on right now in between Russia and Ukraine, China, economic uncertainty, the Fed, whatever it is, the market doesn't like uncertainty. The market gets more volatile when things are uncertain. So, if you think about it, the outperformance in an election year when a sitting president is running again, that could be reduced to, or that could be attributed to reduced uncertainty. That the incumbent, if that person returns, at least people in the marketplace are familiar with that person, familiar with their economic policies, et cetera, et cetera. Again, non-political here. I'm just giving you the stats. Okay. Now, last one on this. Regardless of which party is victorious, okay, regardless, the almanac, that's where I'm getting these stats from. The almanac says that the last 7 months of an election year, so we're talking basically May to the end of the year, have seen S&P post gains 16 out of 18 times since 1950. For the record, okay, one of those losses was back in the dot-com bubble, back in 2000. Okay, but also, what happened in 2000? The election was delayed for 36 days. Okay, so some uncertainty there. So just playing out some of those stats for you. Just looking up here, the market S&Ps have rallied about 5 points in the last couple minutes here. Let's talk about some price action. okay, in the market today. And where would we be without looking at Nvidia, right? So earlier today, about an hour ago, there was a massive buy, and let's get this up here, of next week's expiring at the money calls, the 1140 strike call. Excuse me, 1140 strike calls. Now, those have to be really expensive options. Somebody wants those at the money options going into the split, because remember, this Friday is the last day that Nvidia is going to be trading at 1140, 1150. It's all going to be a 10 for 1 split when we come in next Monday. So the stock, let's say it's 1150 right now, the stock would be 115 next Monday, and someone would own 10 times the amount of shares, okay, that they have right now. Well, these 1140 calls, someone bought 4,200 of those, and now we can see that right here, there's actually 7,700 of those on the tape today opening. Those are opening. So they paid approximately, they paid about $42 each for those. Now, $42, that's $4,200 per option. Okay, so one customer bought 4,000 of those. So that's going to turn into next Monday 40,000. 40,000, that's right, 4,000 times 10 of the 114 strike call. 40,000 of the 114 strike call. Okay, that is a really, really big order there. The order flow in Nvidia has been still incredibly, incredibly bullish going into the split. And I will tell you, just historically, okay, going into a split, especially a major stock like this, we typically will see a run up, as we've seen. You may see a little bit of some give back, a little bit of sell off Thursday or Friday going into the split. But what happens typically with option implied volatility, and I'm going to pull up a chart here for NVIDIA implied vol, is we typically see a pop up into the split, which we certainly have seen. Okay, this is where we were. We see this rise. It's certainly not as pronounced as if it was going into earnings. But then after the split, what do you all think happens if we've got 10 times as much of something as we did? What do you think may happen after the split? Things are going to get tighter. Typically, things will get tighter and vol will probably come, I don't want to say crashing down like from an earnings play down to here, but vol will probably get hit. Okay. So, regardless of directionally, of positioning, what you're looking for up, down, be careful, guys. Be careful with volatility going into the split because we can see a drastic change. Um, Another big one in the news today. Earnings this morning that fell way short of expectations. Okay, Bath and Body Works, somewhat of a memer, somewhat of a meme stock. Over the last couple of weeks, caught a lot of attention going into their earnings. Okay, well that stock is getting pummeled today. That stock is down almost 15%. And the volume today is huge. Average daily volume on this thing is about 2,800 contracts. Today it's already well over 50,000 contracts. So maybe something to watch on all of your radars there. BBWI, Bath and Body Works. Okay, we already talked about that the S&Ps held their 50-day moving average last Friday. We're going to see if it tests that again. And CrowdStrike is another one getting a lot of interest today. That's because they have earnings after the close today. So if we look at that volatility again, if we look at that implied volatility and think about uncertainty, what I had talked about before, guys. Why do we see these spikes? Why do we see those spikes in volatility? Well, those are leading up to earnings dates. And I'm going to put this on a 1-year chart now, and we can see earnings, 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 earnings. And why is that? Why do we see that? Okay, well, what happens when a company is about to release earnings? Typically, that happens 4 times a year, every quarter. So one day each quarter, one day out of the other 89 days of the quarter, we know that the company is going to come out and they are going to say something. They are going to tell us what their performance is, what their expectations are, right? So there's that one day that is unlike the other 89 days of the quarter. Well, leading up to that, if we know there's material news coming out, that adds what? Uncertainty to the marketplace, right? So what happens with uncertainty? Boom, you see these spikes in volatility. Okay. I want you to kind of think of something here, and for any of you, most of you, all of you, whatever, any of you that have ever been driving along and all of a sudden you see the police lights behind you. How do you feel? What does it feel like? You probably tense up. You probably get nervous. Maybe you feel, that angst in your stomach, right? Well, that's because of the uncertainty that just happened to you. So that's kind of the same thing of what happens. Exactly, Kim, you feel anxious. Well, what happens when people are uncertain about the market? They feel anxious. They want protection. They get scared. What happens when when you really want protection? When, you get scared, blood pressure rises, volatility goes up. So when you see that happening in the marketplace, whether it's overall like in the S&Ps or the VIX or even just a particular stock, think about it that way. That is exactly the market dynamic of what is happening to implied volatility. But as is the case, well, at least I would say most of the time with us humans, as is the case with options, eventually that volatility is going to go away. Things are going to settle back to the norm. And so we see that volatility come down. What happens when volatility goes up? Prices get more expensive. What happens when they come down? Prices get less expensive. So as traders, and again, this is going to be very, very important for anybody with a NVIDIA position going into the split. As traders, we not only want to look at support, resistance, other technicals for where stock price may be, but if you're trading options, you need to look at where is volatility, implied volatility, where is the premium? Okay, higher volatility, you're going to pay more. Or on the flip side, if you're selling options, you can collect more. Lower volatility, you're going to pay less. So we need to follow the support and resistance same way when we're looking at implied volatility as when we're looking at direction of a stock. Think of it this way, guys. Okay? You want to go buy insurance, okay? You talk to your insurance agent or you're pricing out your homeowner's insurance, your auto insurance, your personal articles, whatever it is. You want to get it as cheaply as possible. You want to get that insurance when nothing is happening, right? If you know that big storms are about to hit your area, and we've had, unfortunately, some really bad weather across the country recently, but if you know big storms are about to hit your area, and you then want to go out and buy insurance, homeowners insurance, what do you think's happening to the prices there? You're going to pay more. You're going to pay more. Okay. So think of it that way. I mean, there's so much that aligns between what happens in our everyday real lives and trading. All right, folks. I can't believe that is a half an hour already. S&P is almost getting back to the flat line here. Let me get charts up here really quick, guys. I'm hoping that you guys liked some portion of this. maybe not the whole thing, but some portion of this. I know I love doing this. This is my home away from home. So I'm like a kid in a candy store here. I'm like in summer camp right now. Um, if you guys can all give us feedback, I would love it. Good, bad, and different. I'm a big boy. You want to tell me something you didn't like? Go ahead. Not going to hold it against you. We want to make this what you want to hear. We want to make this so this is enjoyable for you. We want to make this so it's actually worth your time to watch. So thank you so much, everybody. This is Minds of Markets live down on the floor here in the S&P 500 options pit at the SIBO. Can't wait to see you next time, guys.